Restaurant Payment Processing Example by avibusinesssolutions.com. A dinner rush tells you everything about your payment setup. Cards are tapping, servers are splitting checks, online orders are firing into the kitchen, and one slow terminal can back up the whole front of house. That is why a clear example of restaurant payment processing matters. It shows how money actually moves through a restaurant, where fees show up, and what kind of setup supports speed without cutting too deeply into margins. For restaurant owners, payment processing is not just a back-office line item. It affects table turn time, staff workflow, guest experience, tipping, reporting, and cash flow. A processor that looks cheap on paper can become expensive if approvals are slow, chargebacks increase, or deposits take too long to hit your account. A better setup usually balances cost, reliability, and operational fit. A simple restaurant payment processing example. Let's use a small, casual restaurant doing $80,000 in card sales a month. The business handles dine-in, takeout, and a growing amount of online ordering. About 70% of transactions are card present, 20% are online, and 10% are keyed in for phone orders or special cases. The restaurant uses a cloud POS, 2 countertop terminals, 2 handheld devices for tableside payments, and an online ordering system tied to the same reporting dashboard. A customer taps a card at the table for a $60 check. The payment data moves through the terminal, gets encrypted, passes to the payment processor, then to the card network and issuing bank for approval. Once approved, the transaction is authorized, the tip is adjusted after signature, and the batch is settled later that night. Funds typically arrive in the restaurant's bank account within 1 to 2 business days, depending on the processor. Now apply sample pricing. Suppose the processor charges 2.6% plus 10 cents for card-present sales, 2.9% plus 30 cents for online orders, and 3.5% plus 15 cents for manually keyed transactions. If the average ticket is $40 and the restaurant runs 2,000 monthly transactions, the blended processing cost could range from $2,300 to $2,800 per month. That range depends on ticket size, card mix, rewards cards, online order volume, and whether any monthly platform fees or PCI fees are added. That is the useful part of a restaurant payment processing example. It moves the conversation away from advertised rates and into actual business math. What this example shows is that restaurant owners. The first lesson is that restaurants rarely have one payment channel anymore. You are not comparing a single terminal rate. You are managing in-person, online, mobile, and sometimes invoiced or keyed payments. Each one has a different cost profile and fraud risk. The second lesson is that speed matters as much as fees. If your tableside checkout cuts 5 minutes off each table turn on a busy weekend, that operational gain can outweigh a slightly higher hardware cost. If your online ordering platform reduces manual mistakes and sends cleaner data into your reporting, that also has value beyond basis points. The third lesson is cash flow timing. Some processors fund the next day. Others stretch deposits, hold reserves, or delay access when volumes spike. For a restaurant buying inventory every week and covering payroll on tight timing, funding speed is not a minor detail. The real cost behind restaurant payment processing, example pricing. Many restaurant owners start by asking for the rate. That makes sense, but the rate alone does not tell the story. Pricing models can include flat rate, interchange plus, tiered pricing, monthly software fees, PCI compliance charges, statement fees, gateway fees, and hardware leases. Flat rate pricing is easy to understand and often works well for newer or lower volume operators who want predictable billing. Interchange Plus can be more cost-effective for higher volume restaurants because it separates the actual card network cost from the processor markup. Tiered pricing can look simple, but it sometimes hides more margin for the provider, so it requires a closer review. In a restaurant payment processing example, the cheapest quote is not always the lowest total cost. If one provider offers a lower transaction rate but locks you into expensive hardware, higher chargeback costs, or weak POS integration, your total spend and your staff's frustration may still go up. Hardware and POS fit can make or break the setup. Restaurants need more than a basic card reader. A practical setup often includes countertop terminals, handheld devices, kitchen routing, tip adjustment, split checks, menu sync, and integration with online ordering. Fine dining, quick service, food trucks, and multi-location concepts all use payments differently. A full-service restaurant may benefit from handheld devices that allow guests to pay at their tables. That improves speed and reduces staff card handling. A quick service operator may prioritize line speed, self-service kiosks, and acceptance of digital wallets. A bar may need tabs, pre-authorizations, and clear end-of-night reporting. This is where choosing the right provider becomes a business decision, not just a payment decision. If the processor works well with your POS and order flow, your team spends less time fixing tickets, re-entering data, or chasing missing tips. Risk, chargebacks, and fraud in restaurant payments. Restaurants are not immune to fraud. Card-not-present transactions from online and phone orders pose a higher risk than in-person payments. Chargebacks can happen when customers do not recognize a business name on their statement, dispute a delivery issue, or claim food quality problems after the fact. A good payment setup helps reduce that risk. Clear merchant descriptors, address verification for online orders, digital receipts, tokenized card storage for repeat customers, and integrated order records all help. So does having a processor that gives fast visibility into disputes instead of leaving you to react after the loss lands? There is a trade-off, though. More security controls can add friction. Requiring too many checkout steps may reduce online conversion. Restaurants need a balance between fraud protection and an easy buying experience. When funding speed matters most. If your restaurant is stable, a 2-day funding window may be fine. If you are managing thin margins, seasonal swings, or rapid growth, faster funding can make a real difference. Card deposits affect inventory orders, payroll timing, vendor payments, and your ability to move onto opportunities. This is why some owners pair payment processing with broader working capital planning. If your processor delays deposits during peak periods, your cash position can tighten exactly when sales are strongest. For restaurants opening a second location or upgrading equipment, it helps to view processing as part of a larger financial system rather than a standalone service. That is one reason business owners turn to providers like AVI Business Solutions. The value is not just access to payment processing. It is the ability to think about payments, cash flow, and funding within a single practical framework. How to evaluate your own restaurant payment processing example. Start with your last 3 months of statements. Look at the effective rate, monthly sales volume, average ticket, refund volume, chargebacks, and the share of sales from online versus in-person orders. Then compare that against your current operational needs. If your team is still walking cards back and forth from the table, hardware may be the issue. If your online sales are growing fast, gateway and fraud tools deserve closer attention. If deposits arrive too slowly, funding terms should move higher on your priority list. Ask direct questions when reviewing providers. How fast are deposits? What happens during volume spikes? Is the POS integrated or patched together? Are tips, split checks, and menu sync handled cleanly? Is pricing flat rate or interchange plus? Are there cancellation terms, PCI fees, or equipment commitments? A strong provider should answer these clearly. If the quote is hard to understand, billing will likely be the same. Choosing the right setup for your restaurant. There's no single best processor for every restaurant. A food truck may want low upfront cost and mobile flexibility. A multi-location group may want deeper reporting and centralized controls. A neighborhood restaurant may care most about fast deposits and easy staff training. The right move depends on your sales mix, service model, and growth stage. What matters is choosing a system that supports revenue, protects margins, and doesn't slow your team down when the restaurant is busy. If you are reviewing providers, use a real restaurant payment processing example like the one above and plug in your own numbers. That gives you a clearer view of cost, workflow, and funding impact than any advertised rate ever will. When payments work the way they should, your staff moves faster, guests check out easier, and your cash flow becomes a tool for growth instead of another daily problem to manage.
Running a small business means being ready for anything. But what happens when the big banks say no? At AVI Business Solutions, we say yes.